Okay? This is, if you remember, we were talking about. Okay, should I give you like a minute to get it out of your system? Because I still need a lot of talk. Okay. Now, we were talking about liabilities. Last time we stopped here where we were talking about long-term notes payable, and we learned how to calculate both interest expense and how to calculate the reduction in principal. The payment is always the same. What changes is the composition of, basically is the part of each component. Interest expense will be made up of two components, which are interest and so the payment, the monthly payment, or the semi-annual payment, or the annual payment of a long-term notes payable will be divided into two parts: interest and principal. It's the percentages or the part of each component that will change. As you can see, if you add this one and this one, it will always be the same. And the journal entry would be, this is when we actually record the actual signing of the mortgage. The company will receive cash, $500,000, and they will sign a note, a new liability, so we credit mortgage payable. When later on the first payment is to be made, it will be interest expense. That's always the same thing. Interest expense will be the interest rate multiplied by the carrying value. Okay? Mortgage payable, that will be the part that is calculated by subtracting, as you can see here. This one, it's simply the rate, so this is the interest expense, it's the rate multiplied by the remaining balance in the principal. So this is the balance in the principal. Sorry, I said that the carrying balance in the principal. And then when we subtract interest expense from the payment, from the semi-annual payment, that will give us the reduction in principal. We subtract the reduction in principal from the balance in principal, that will give us a new balance in principal. Now this is the new balance in principal. This is where we will apply, this is what we will apply the interest rate. We will apply the interest rate to the new balance in principal. Okay? So interest expense will be principal. Sorry. Will be the principal minus reduction in principal. This is the new balance in principal. Okay? This is the reduction in principal. Anyways, now, presentation. How do companies present long-term liabilities? You have long-term liabilities, you list bonds, notes payable. Usually, you list the percentage, you list the due date. So you have the percentage, the due date, you have for mortgage payable, you also have some kind of basically the notes terms. Okay, so this is 11% due in 2026 and secured by planned assets. So this is a mortgage, more or less. It's a mortgage because it's secured by assets. Okay. As you remember, the long-term liabilities that are maturing within a year, that are due within a year, will be actually listed under the current liability section. There are two ratios that creditors and investors and basically users of information look at in order to analyze the company's performance. One of them is debt to asset ratio. Now, debt to asset ratio is simply looking at how much debt you have compared to your to whatever assets you have. So it will be this is where you divide total liabilities by total assets. The idea here is to look to find, for example, for every dollar of liabilities of debt, how many dollars of total assets you have to cover them. So, for example, if you have here, in this case here, you have 79.7%. That means the liabilities, they are equivalent to almost 80% of your assets. The higher this ratio, the worse it is. The riskier the company is, because in this case, you have higher debt. Okay? So, debt to asset ratio, it's looking at basically the percentage of your assets that would be equal to your liabilities. This will look at the company's ability to pay their debts. Okay? Debt to asset ratio has identified basically the company's ability to pay their debts times interest earned is to look at the company's ability to pay their interest that has their interest expense basically, to pay the interest that they are supposed to due to their loans and stuff like that. So in this case, you divide net income plus interest expense plus income tax expense. Okay? You divide that by interest expense. In this case, it will tell you how many times the company can pay their interest. So in this case, it's 6.71 times. And the higher the number, the higher the ability of the company to pay interest. So if you are going to invest in the company's bonds, you would like to know that the company can continue to pay their interest. We get to the amortization of bond discounts. Remember, we were talking last time, we were talking about unamortized premium and unamortized discount. This is where we will learn how to do that using the straight line method. Here we are using the straight line amortization method. We simply divide the discount or the premium by the number of interest payments. So for example, we said that for bonds, how often is interest paid? You guys remember that? How often is interest paid with bonds? Yes? Semi-annually, which is to mean twice a year. So if you have a bond for 10 years, the life of the bond is 10 years, how many payments, interest payments are expected? 20. So you divide, in this case, the bond discount or bond premium over those 20 payments. This will give you the amount of discount that is amortized. So how do you calculate it? Like Candlestick Inc. sold, this is the same example that we had last week. They sold $100,000 5-year, 10% bonds on January 1st, 2015 for $92,639. This means that it is a discount of $7,361. Okay? So this is equal to 100,000. Sorry, I don't know. I know. So, okay, so this is equal to 100 minus this amount. Okay? So, interest is payable on July 1st and January 1st. we have bond discount is 7,361. It has a 5-year life, so 10 interest payments. Okay? We divide bond discount by 10. In this case, it will be 736 for every payment. Now, interest that the company will actually pay, so the interest that is actually to be paid, this is the amount that the company will actually have to pay. Okay? This is 5,000. That's based on face value multiplied by interest rate multiplied by 6/12. Okay? This is based on the contractual interest rate and the face value. That's the amount of check that will be sent to bond owners. Now, the interest expense that the company will recognize and will record will also include the amortization of bond discount. So in this case, the discount amortization per payment is 736. You add that to 5,000, which is to the 5,000 in this case, which is the actual payment. The interest expense that the company will record with every interest payment will be 5,736. Okay? That's the amount that the company will report. 5,736. On the other hand, columns D and E. So the columns A, B, and C, they give you the amount that will be used to make a journal entry. The journal entry will be to debit interest expense, and then you credit cash and discount. Okay? Now you subtract, every time you subtract the discount amortization from the unamortized discount. That will give you the remaining part of the new unamortized discount. You remember when we were talking about when the company actually retires a certain bond before maturity. When they buy back a bond before maturity, the problem used to give us, for example, that you have $10,000 or $8,000 of unamortized premium or of unamortized discount, right? This is how this is calculated, by subtracting the amortization of the discount from the balance and under unamortized discount. Okay? As you can see, the carrying value of the bond will start increasing. Okay? It will start increasing until at maturity, the carrying value of the bond will be equal to the face value of the bond. So this is why when the company retires bonds at maturity, it will be the same as the carrying value. Face value will be equal to carrying value. You guys have any questions about this? And just to let you know, Excel can do that very, very, very quickly. If you want to try it with Excel, I actually intend to upload a file, an Excel file where you can simply drag the formula and then you can see how fast it will complete the whole amortization table. Okay? Now, this is the journal entry. It will be interest expense, discount on bonds payable. This is the amortization amount, 736, and then you have cash. This is the actual amount paid. So the 5,000 is the amount that is actually paid. 736 is the amortization. Bond premium is the same thing. Now, however, it's the same concept. It's the other way around. Here, bond premium will be subtracted from the amount of interest that will be paid. It's not added. Because bond premiums, they decrease the cost of borrowing. So in this case, you have 5,000 minus the premium, which is 811. Okay? You subtract that, and this will give you the interest expense. The interest expense in this case is 4,189. It is amount that will be paid minus the amortization of premium. Once again, we subtract the amortization of premium from the balance in from the unamortized premium. That will give us a new unamortized premium. Okay? And this is the new unamortized premium that will be added to face value. Now, as you can see, in this case, the carrying value will start high, and then it will start decreasing until it reaches face value at maturity. Once again, this is why a company, when they retire a bond at maturity, whether it was sold originally at premium or at a discount, it will always pay face value because of this amortization, because of the amortization of premium and of the discount. Okay, in this case, interest expense will be, so for the journal entry, interest expense will be debited 4,189, that's equal to 5,000 minus the amortization, and we have premium will also be debited. Remember that we are trying to decrease it, so it has to be debited. So we debit premium on bonds payable, the amortization amount, we credit cash 5,000. Cash will be credited 5,000, regardless of whether we are amortizing a discount or a premium. This is the amount of cash that is based, the amount of cash paid. It depends on the face value and the contractual interest rate. It has nothing to do with the premium or discount. That's the amount of cash paid. Do you have any questions about liabilities? Before we talk about investments.